Sadler, CEO of Allegiancy. Appreciate your time and attention today. We'd like to walk through briefly a summary report of the things that have been going on at Allegiancy since our offering closed, and it's now essentially the end of the third quarter of 2014. So I appreciate you joining the call. Look forward to answering any questions that you might have after the presentation. To begin, I want to mention that we have a disclosure and disclaimer statement up on your screen to note that we will be discussing forward-looking statements and under the securities laws. We wanted to make sure that you guys had access to this disclosure and disclaimer, that you wouldn't, as an investor or a representative, place undue reliance on these forward-looking statements. Many of them will be speculative in their very nature. To begin, what I'd like to do is go through a brief review of our strategy. I know that you are all aware of this. Most of you participated in the offering, but I want to at least give you an overview again of who Allegiancy is and what we're doing. As you are aware, Allegiancy is a real estate asset management company. We specialize in protecting equity owners' interest in their commercial real estate investments. We are at the current moment confined, or I guess we're strategically focused on commercial real estate in the office sector. The multi-tenant suburban office buildings is really our specialty. But we are a pure play in that Allegiancy does not own any real estate. We manage real estate on behalf of the owners. We do the asset management and oversee property management and leasing activities that are provided by third parties. And our core function is really a fee-based asset management function. The reason that's important to you guys is that you need to understand, or would like for you to understand, that commercial real estate exposure for your investors is a good diversification component. But here with Allegiancy, you get the benefit of that diversification without the volatility that direct equity ownership might entail. And so as a pure play fee-for-service asset manager, Allegiancy's revenue stream is more stable and more secure without all that volatility. So our strategic approach at the moment, we have been, since our closing, we've been diligently executing our business plan. And just to review the strategy for you, we are focused on continuing to refine and deploy the technology platform that we have designed and built over the last decade or so. We are expending meaningful resources in business process management, business process automation systems that will allow us to continue to scale Allegiancy's operations profitably and for us to take on a larger asset base, which is part of the strategic plan. And so our protocol, as we raised $5 million through Maloney Securities with the closing back in April of 2014, that capital is designed to do two things. One is to assist us in building out the platform, the technology that I just mentioned, but then the other part is to acquire asset management contracts. Our expectation is to have a portfolio with assets under management in the order of $1 billion sometime in 2015, headed toward $15 billion in assets under management in 2020, and we are working on acquisitions on multiple levels to achieve that. The other piece here, strategically, we're working to expand our strategic alliances with referral sources like attorneys, financial institutions, et cetera, where people have clients or interest in real estate that could use a more effective and efficient asset management oversight. Related to all of this, we have been working diligently to establish Allegiancy's brand in the marketplace. We have a fairly significant PR effort with blog posts and website updates and interviews in the media publications, some related to real estate, some related to other things. And so we're working to keep Allegiancy out front as a thought leader and as a trusted resource for people that are investing in or operating or connected in some way to commercial office buildings. And all of that is part of our effort to continue to develop the pipeline of acquisition targets. As you may recall, we have a multi-pronged strategy for growing the company. The first is to continue to do all of the things that brought us to this point and created the successful company that we already are, that namely being leveraging our relationship and resources that would allow us to bring in contracts by referral, one at a time, two at a time, from people who know us and may already be aware of our work. And then the second piece is to acquire asset management companies where we can acquire a batch or a chunk of contracts all at once from an existing provider looking to either exit the business or reposition themselves for greater effectiveness. And then the third is to pursue institutional client relationships where our service platform and demonstrated success in delivering results will improve the performance for that institution. And so all of those things are going on today as part of positioning us for a $20 to $30 million secondary raise. We originally hoped that that would have been Q1 of 2015, but with the delays at the SEC in promulgating Regulation A+ rules, we're now hopeful that in the second quarter of 2015 we'll be able to move forward with that secondary offering. I guess, the most important piece for you at the moment is that what's on your screen right now is our financial performance through the end of September. Be mindful that these are internal, unaudited, non-GAAP numbers. Audited GAAP financials will be provided annually for the going forward. But what we're looking at here are our internal numbers. On the income side, you'll see administrative fee income, management fee income, and then reimbursed expenses. Management fee income is really our bread and butter. This is the fees that come in based on operating the properties for ownership. That will generally be about 50% of our revenue stream. The administrative fee income at $1.3 million in the period that we're discussing is event-driven or life cycle event-driven fee revenue from construction management, leasing commissions, refinancing fees, sale fees, things of that nature. Generally, that number will net out to be about 50% of our revenues. What you see here is a total income of north of $2 million, which puts us ahead of our schedule. And we're very pleased to be reporting numbers like this. Under cost of goods sold, you'll see the administrative fees coming at $478,000. What that basically boils down to, if you were to drill down into the numbers more deeply, is real estate leasing commissions paid to outside brokers. So of the $1.3 million that comes in to Allegiancy on administrative fee income, call it $500,000 goes back out to third-party providers. On the management fee side, the numbers that you see are for property management and other services that would be paid out to third-party providers. So what you're looking at total is about a gross profit of $1.3 million, and that's ahead of schedule. We're pleased, of course, to see that. And then you begin to deduct the operating costs of the company, including staffing, rent, professional fees for consulting and technology and various things of that nature. And you end up with about $573,000 of net income. Again, that number puts us ahead of schedule. One thing that I'd point your attention to, the entire 12-month period dividend payable out to our Class A equity shareholders is about $350,000. So we've already, in the 6 months being reported here, we have already earned well in excess of what's needed to cover those dividends. And that was part of our original discussions with Maloney. The fact that we're a profitable enterprise is an important piece of the platform going forward. And so back to our growth plan, what we're looking to do in the next 12 months is to focus on acquisition of additional asset management companies. We do have a number of transactions in the pipeline. As with many things, it takes longer than we might hope for some of these things to come to fruition. But today we're looking at a closing in January for approximately a $450 million asset manager that will drop those $450 million worth of buildings into our management company. So that will take us from give or take $300 million of assets under management in at the end of September of 2015. We'll add about $450 million of assets under management in January of 2015. Then we have additionally 2 or 3 other transactions that we are expecting will close in a 4 to 6 month time frame that should add another $300 million in assets under management. As you may recall, our target was to be about $900 million of assets under management at the end of the first year. So our goal is, come April of 2015, to be someplace very close to $1 billion of assets under management. We are also in active negotiation for smaller transactions, call them onesies and twosies asset management contracts that we will expect to have those close sometime in the first quarter as well. And then we're working on a new effort that was alluded to previously, the private label services for institutional clients, where we can come in and work with a private equity firm or a small pension fund to deliver asset management services for them, allowing them to redeploy resources in areas that might be more profitable for that enterprise, like acquisitions or capital fundraising. We can step in as Allegiancy and deliver services to manage their properties and administer those assets more efficiently than they can, and delivering better financial performance than that institution has previously been able to deliver. And so that's a new effort that is just getting started. There's a lot of work, as you might expect, that goes into that. But we're excited about that opportunity. There's a very large universe of small institutions whose track record of asset management is relatively sketchy. So we're excited. We have, I think, a very good future in front of us. We appreciate your support, and we'll look forward to working closely with Maloney Securities in 2015 on the secondary offering. Now I'm open the floor for questions.